Good morning. It is July 21st, 2025. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer for Cantor Fitzgerald Managed ETF Portfolios. This is my weekly market and economic commentary for the week beginning today. If I have something to say intra-week, we'll put it on LinkedIn and or on X. The handles are Herb Morgan on LinkedIn, at Herb W. Morgan on X. Everything you're seeing and hearing is developed by me. It is to be used by both investors and financial advisors, but everybody is expected to make their own investment decisions. Nothing contained in the presentation is investment advice. There's no tax advice, no recommendation to buy or sell a security. Everything is for informational purposes only. The views are mine and mine alone and may not represent the views of CFIA's parent, affiliates, or other portfolio managers at the firm. Well, the S&P 500 rebounded last week after a very modestly down week the week before. Mid and small cap stocks were down a little bit, as was international, but look at emerging markets. Big tear there. Bond markets were steady. High yield up almost 0.25%. Overall, just another good week. We're just super close. At last I checked this morning, we're about 1.5% off of an all-time high in the S&P 500. You know, one of the aims of the current administration has been to revitalize domestic manufacturing. We know that from whether it's the tariff policy, the tax incentives for capital expenditures, their efforts to attract foreign direct investment in the United States. And so we're going to start, now they've been around about 6 months, we're going to start looking at the manufacturing sentiment indicators and other indicators to determine whether or not they're having success. And early on here, we've got New York State Manufacturing and Philly Fed for the month of July, both reported last week. Let's start with Empire State or New York State Manufacturing. As you can see here, circling on the right for New York State, came in at 5.5. The estimate was for minus 9.2. Prior month was minus 16. Basically, manufacturing's been in a massive slump in New York for a period of time. Now it's just one up month, but first one in 5 months exceeded even the highest estimate of the economists that reported in. Prices rose, however, that's a big negative, rose to about. Moving on to Philly Fed survey, another regional survey, estimate there was for minus 1, came in at 15, circle that for you, 15.9. Up from June's 4, also the highest reading in 5 months, just like in New York. Prices paid rose there in New York too. So this is a big problem, right, for the Fed to cut rates. They've got to see improvement on the inflation front. And at least in these two surveys, they didn't get it. On the CPI side, the CPI rose 0.3% in June. Okay, that's fine, 0.3%. Core was up 2. That was better than expected. That's good. Year over year, though, core at 2.9 is well above the Fed's target range of 2%. But what's about to happen? I showed you this a couple weeks ago. It's worth showing you again. When we get the July reading, which will be in about 4 weeks, 3 weeks, this 0.2 rolls off. So if 0.2 rolls off and 0.2 rolls on, not that much difference. If 0.1 rolls on, okay, that's a little improvement. But then we go through August through January where we have big months roll off. And when those months roll off, that's when the year-over-year number is going to start to improve, provided the months coming up ahead are not horrible months either. We will see, but this is the goal of the administration. This is try to get this down, get it where it needs to be. When that happens, obviously, then the Fed can feel that they're more clear in their ability to cut rates, to recognize that inflationary pressures have presumably come down. Same thing, really, if you look at PPI. It was actually flat on the month, which was really good. The core there came in at 2.6, beating the estimate of 2.7. The core for the month, 0, beat the estimate of 0.2. And here again, now the July number last year was negative. So when that rolls off, we're not going to get any improvement in PPI year over year. But then we've got, look at all these numbers through January that are going to roll off. 0.4 and then a 0.6 in January itself. This is the kind of thing that really will, if it happens, will help to bring down some of those inflationary pressures. We had industrial capacity and utilization industrial production and capacity utilization last week. Up 0.3 for production, beating the estimate. Capacity utilization was a little above, but not in an inflationary area. I always draw the line here at 80. When capacity utilization gets to 80%, that starts putting pressure on prices, and it is considered inflationary. 77.4, that's fine, that's all good. We got the Fed's Beige Book last week. This is the book that goes out ahead of the meeting, which we know is July 29th and 30th. Incidentally, we have a webinar right after that meeting. If you haven't signed up, please go to Cantor Asset Management's website and sign up for that. We'd love to have you. It'll be a live version of this commentary plus some other discussions, as well as a Q&A with yours truly. From the Beige Book, we gather that economic activity increased a little bit, consumer spending decreased a little bit, loan activity is up, meaning banks are willing to make loans. That's good. Construction still very soft. Employment good. Hiring, though, is cautious, and significant pickup in investments in automation and artificial intelligence. This is the kind of thing that ultimately delivers profit growth and profit margin down the line. One of the reasons the market's doing so well right now is this belief that we're going to start really seeing the value of the AI investments get into the bottom line across industries, not just specific to AI or technology. Markets are now pricing in less than a 5% chance of a rate cut on July 30th, so looks like I got that one wrong. And the odds of a rate cut by September 17th are only about 58%, so I'd say almost 50-50. They are now pushing it out to October. I'm going to go ahead and make the prediction now, even though I made the July one incorrectly. September 17th, Constitution Day, will be the rate cut, probably just a modest 25 basis points. And they'll signal that probably on the July 30 meeting. Retail sales in June were expected to go up 0.1%. They didn't. They went up 0.6%. So that was pretty good. Backing out autos and gas, also up 0.6%. That's better than expected. Everything looks good in retail land. Weekly initial claims for unemployment expected at 233, came in at 221. That's fantastic. Continuing claims still below 2 million, also fantastic. Labor market's still good, not as strong as it was. I explained that in detail in last week's report. If you hadn't seen it, it's worth going back to look at and understand that. But that's certainly great. At 221, you just can't beat that. Housing starts and permits for the month of June, they're just miserable. This is an industry that's waiting for interest rates to come down, despite the fact that the overall economy is good. Housing starts came in at 1.3 million, 1.32, permits at 1.4. Both were a little above estimates, so that's fine. We also got our second month of a pickup in consumer sentiment. You can see over here on the right, you can see that poking its little head up there. 61.8, estimate was 61.5, that's up from 60.7. 5-month high, that's great, but we're not getting inflation expectations coming down the way we'd like to see. This is important, and we're not going to see this number back in that 100 until such time as well. Stock markets continuing to do what they do is great, but we need those inflation numbers to bring down inflation expectations. Sometimes it's expectations themselves that can drive inflationary pressure. Do you expect prices to go up? They do. That's not good. We want to see inflation get all the way back down to 2%. Quite frankly, I'd like to see it at 0. Not a ton of economic data this week. We're going to start with the leading economic index. We got that this morning. It actually came in at about minus 0.3, right in line with expectations. Nothing on Tuesday. Existing home sales for June expected at a pace of 4 million. Weekly claims good. Flash reading from S&P Global on manufacturing and services 52.5 and 53. Those would be great if we get those numbers. New home sales at 650, annualized pace, not so good. We're going to get building permits in July, and then durable goods orders expected to be a big drop. Remember, big gains are usually followed by big drops. I'm not worried about that. 104 S&P 500 companies are going to report earnings this week. The big ones, Tesla, Alphabet, IBM, Intel, and General Motors. 61 only have reported so far in this earnings season. but the average beat, the earnings surprise beat at 7.5% is a pretty darn good number. Thanks for tuning in. I'll be back to you next week. This is Slaying Bulls and Bears. I make the complex and complicated simple and sensical. Don't forget to follow me on LinkedIn and or the X. Thank you. I'll be back again in 1 week.